Welcome to The Truth About Taxes and Retirement. This podcast is brought to you by SavingYouTaxes.com and hosted by J. Barry Watts. As an advanced tax strategist and enrolled agent federally licensed by the IRS, Barry is uniquely qualified to go deeper into the Internal Revenue Code than most accountants. He understands and interprets its provisions, explaining how they'll help you reduce income taxes you owe so you can direct that previously wasted tax money into tax-free accounts that you can enjoy in your retirement years. Now, on today's episode.
Hello, I'm Barry Watts from The Truth About Taxes and Retirement. Today's episode is part 2 of a 3-part series called The 3 Don'ts of Retirement. These episodes come from surveys we've taken of thousands of people who were preparing for retirement and who we've asked, what is your biggest concern? And we've compiled that information and come up with the 3 greatest concerns. The number 1 concern is don't run out of money. The number 2 concern is don't overpay taxes. And the number 3 concern is don't become a burden to my family. Now, we talked about the number 3 concern last episode. We're going to talk about the number 1 concern next episode. And on this second episode of the series, we're going to talk about not overpaying your taxes. Let me ask you this question. Do you think taxes are going up or down over the course of your retirement? Our government owes $31,000 billion. $31,000 billion. That's kind of an odd way to say that. It's $31 trillion, really, because 1,000 billion is a trillion. I think, at least that's what they say. I don't know. This isn't a number in my checkbook that I have to deal with. But the government owes $31,000 billion. Now, by 2030, that's only 7 short years away, the net interest that the government pays is going to exceed $10 trillion per year. Currently, our federal revenue from taxes is only $4 trillion a year. So the government's going to need to be spending 10 just to pay their interest bill. And right now, from all sources, they only take in $4 trillion a year. That's going to be a problem. And there's only one solution to that problem, and that is to raise taxes. Now, when you went to work 40 years ago, they offered you and me 2 things, 401ks and IRA accounts. And they told us if we'd put money into those things, they'd give us a tax break for our contribution. And then they said, when you retire and start taking that money out, you'll be in a lower tax bracket. Well, let me just ask you this. Are you in a lower tax bracket today than you were in your 20s, your 30s, your 40s? You see, IRAs and 401ks are fine tools for accumulating money, but they are terrible tools to retire with. Any account which you have to pay taxes in retirement on is a problem account because you don't get to control the tax rate and you don't get to control when you take the money out. Let's take the first rule of IRAs. It works like this. The first rule is that you're required at age 73 to make required minimum distributions, also called RMDs. Now, you might say, well, see there, that guy, he doesn't know anything because we all know that RMDs start at 70 and a half. No. They used to start at 70 and a half, but Congress passed the Secure Act, and that changed it to age 72. And then they passed Secure Act 2.0, which changed it to age 73. So 73 is the age where required minimum distributions start. But regardless of the age, when you reach this magic number, whether you need the money or not, the government forces you to take the money out of the account and pay taxes on it. And then whatever you took out counts against your Social Security to determine the tax you pay on Social Security, and it counts in determining what you pay in Medicare premiums. Now, how much you have to take out is controlled by the IRS. The way they do it is they estimate how long they think you will live, and they determine a percentage that you're required to withdraw each year. So let's say you've got $1 million in your IRA or 401k. In the first year at age 73, you're going to be required to withdraw approximately 3.9%. And in year 2, you're going to have to withdraw about 4.1%. And in year 3, about 4.3%. And so it goes. Every year for the rest of your life, that amount is going to go up. Now, remember, I talked to you earlier and said, I think taxes are destined to go up. There's not any way around this. But do you see the problem? As taxes are going up, the amount that you have to withdraw each year out of your account goes up, and you have to pay taxes at that ever-increasing rising rate. Your tax bill is going to increase exponentially. The required minimum distribution is a massive ticking tax time bomb strapped to your retirement. And it causes your income to go up, which causes your tax bracket to go up, which causes your tax rate to go up, which causes your Social Security tax to increase, which increases the premium you pay for Medicare. And as a result, you will wind up having less Social Security income and paying more for Medicare premiums in your 80s than when you first retire. But I want to show you how to begin protecting yourself from that problem. Let's go back to 2017. That was the year before the last tax law changed. In 2017, let's assume you were married, filing jointly with $100,000 in income. And this applies in the same way to single people, only with a different set of numbers, but the concepts are all the same. So you're married, filing jointly with $100,000 in income. Now, our tax code has brackets. So in 2017, if you made $100,000, you fell into a tax bracket that started at $75,000 and goes all the way to $153,000. Any income falling into that bracket was taxed at 25%. For every dollar of income, 25 cents had to go into federal taxes. Now, would you prefer to pay taxes at a rate you know or at one you don't know? Well, let me ask you this. Do you have it in writing from the IRS what the tax rate is that you will be charged when you're 70 or 75 or 80 years old? No, I didn't think so. So in 2017, if you made $100,000, how much additional income could you have earned and remained in the 25% bracket? Do you remember the bracket started at 75 and went all the way to 153,000? So if you earned 100,000, you could have earned 53,000 more dollars and stayed in the same tax bracket. Now, if we know that taxes are going higher than 25%, why would we not have taken money from our retirement accounts at that cheap rate and paid the tax then at the cheap rate, and then put that money into an account where it would never, ever be taxed again? And there are two types of accounts that are tax-free forever. One you're probably familiar with. That's a Roth account. But you might not know that the other is permanent life insurance with ADB. That's accelerated death benefit that can be used to pay for long-term care. And so now, you're beginning to see that designing your retirement requires a lot of creativity, because there are a lot of resources and a lot of issues that come to bear and things that you have to tie together to coordinate in order to do this successfully. And then you have to deal with the fact tax rates are changing all the time. And in a few moments, we're going to talk about the latest and last tax legislation that passed Congress and how it will affect your future. But first, this word from our sponsor.
A solid retirement plan has many components that most people either never get or have to piece together on their own. There is guidance on when to take Social Security and whether to take your pension monthly or as a lump sum. Then, do you have enough money to be sure your income lasts for a lifetime? Are you stuck paying taxes at unknown but always increasingly higher rates, or can your taxes be reduced? Will you have to pay taxes on Social Security? Is there any way to invest that will extend and protect your money? Which Medicare supplement option should you choose? Is there any way to protect yourself from the devastating financial effects of long-term care? What kinds of estate planning tools are best to extend your legacy to the people and causes you care about the most? These are questions everybody asks, and until now, had to scurry all over town talking with the Social Security office, HR, your accountant, your investment manager, your insurance agent, and your lawyer. It is painful. Let's put some ice on that throbbing pain. Introducing Holistic Retirement Planning from the WealthCare Corporation. All your experts in one spot. One-stop shopping for guidance on Social Security, pensions, tax planning, Medicare supplement, and long-term care planning, estate planning, and tax return preparation. All in one spot. No more driving around town, meeting with different advisors, and carrying messages back and forth. WealthCare's team of retirement, tax, insurance, and legal experts are going to take the burden off your back and make retirement planning easy, so you won't have to fight this battle by yourself and sort out all these issues alone. Let the experts help you build a comprehensive retirement plan that includes long-term care planning, tax planning, and all the other components that comprise a thorough, holistic retirement plan. Don't delay. Call today, 800-278-1755, or visit www.savingyoutaxes.com.
Barry Watts here on The Truth About Taxes and Retirement. We're talking about how to not overpay your taxes in retirement. Now, in 2017, Congress passed a law. It was called the Tax Cuts and Jobs Act. And that bill changed the tax brackets and the rates starting in 2018. So you remember before the break, we were talking about how if you had $100,000 in income, anything from $75,000 to $153,000 fell into the same tax bracket. And so you could take additional income. You could have, if you were making $100,000, you could take an additional $53,000 and not jump a tax bracket. Well, now the $100,000 falls into a new bracket with new numbers on it. For where we stand today, and it started back in 2018, the new bracket is $89,000 on the bottom, and it goes all the way to $190,000. And they didn't just change the bracket, they changed the tax rate as well. Because instead of paying at 25%, now the law says you pay the tax at 22%. So every dollar now gets taxed at 22 cents instead of 25 cents. Now, some of you think, well, 3%, that's not really a big deal. Well, really? Because I know some people who nearly wet their pants when the bank started offering CD rates above 3%. Be honest about it. You'd be happy if you had a portion of your money earning a guaranteed 3% rate, but it's not really 3% because when taxes fell from 25% to 22%, that is actually a 12% reduction in taxes. Now, wouldn't you be excited with a 12% reduction in your utility bill or your insurance bill or your grocery bill? Even better than this, there's another tax bracket we haven't talked about with a different rate that you should look at, because if your income falls anywhere between $190,000 and $364,000, the tax is only 24%. Remember back in 2017, it was 25%. Then it dropped to 22%. But now we can take up to $364,000 and we're still only in the 24% bracket, less than the rate we were paying in 2017. So that gives you a lot of room to take money out of those tax deferred accounts, cleanse it of taxes, and reinvest it into a tax-free account so you won't have to take ever increasing amounts of income from your account. And you won't have to pay ever higher tax rates, causing you to also pay more tax on Social Security and higher Medicare premiums. Now, let me just ask you, back in 2018, did you take out enough additional money from your retirement account and move it over to your tax-free account so you could fill out the bracket you're in? What about 2019? 2020, 21, 22? Have you been doing this? Well, if not, why not? And why haven't your advisors been coaching you on this? Be sure you don't miss another year, because for some people, it will mean at least tens of thousands of more dollars in their retirement accounts. And for many people, it can be hundreds of thousands of dollars of difference. But you have to act. We've got 3 years left, 2023, 24, and 25. Now, in 2026, tax rates are going back where they were before the 2017 tax cuts. So I urge you to act on this while you still can. And one of the things that happens if you reach out to WealthCare Corporation is that we're going to talk with you about our process, which includes taking last year's tax return and then the statements from all your retirement accounts and figuring out whether or not you can benefit from using this strategy. And if you can, how many dollars is an appropriate amount for you to integrate into your Roth, pay the taxes on, and get it in a place where it'll never be taxed again? If you think about it, saving taxes is one way you can make money, even in years when the economy's bad and the stock market is down. For example, last year, the S&P lost just a hair under 20%. Your stockbroker or investment manager may have said, well, just ride it out. It'll be okay. Now, we didn't do that. We got out of the market. But what we then did is we focused our clients on the things we could control. We can't control tax rates, but we can control how much income we receive. And when you control income, you control taxes. So if you'll reach out to us at the Wealthcare Corporation, we can build you a strategic plan to reduce your retirement income taxes and reduce the tax you pay on Social Security and the premiums that you pay on Medicare. There are so many decisions you have to make in retirement. You got to decide, when am I going to take Social Security? Am I going to take my pension monthly or as a lump sum? How much money am I safe to withdraw from my investments each month and not cause myself to run out of money? Is there a better way to invest? Which Medicare supplement should I select? How do I pay for long-term care? What do I need to do about wills and trusts and legacy planning? It can be overwhelming. But you must never forget that even if you get all those things right and you fail to get the taxes right, nothing else is going to matter. Get in touch with us at the Wealthcare Corporation. We'll build you a holistic retirement plan that's comprehensive, answering all of those questions for you. You can call us at 800-278-1755 or visit savingyoutaxes.com, where you'll find additional ways that you can connect. Until next time on The Truth About Taxes and Retirement, I'm Barry Watts. Good day.
This has been a production of the Wealthcare Corporation, found on the web at savingyoutaxes.com. The concepts discussed are for informational and educational purposes only and should not be implemented without first consulting with your own legal, tax, and investment counsel. This has not been an offer to buy, sell, or invest in securities, and this information is to be taken as educational concepts and not as specific advice for you. The lawyers and regulators like for us to remind you that all investment involves risk, and you could lose money. Past performance is never a guarantee of future results. Tax strategy services are provided by American Tax Strategies, LLC. Investment advisory services are provided by Wealthcare Asset Management, LLC.
Thank you for listening to The Truth About Taxes and Retirement podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of savingyoutaxes.com. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional tax and investment advice. Always seek the advice of your own qualified advisor with any questions you may have regarding taxes and investing.